and I hope you all are doing good. So, if you are planning to give CIB December 25, then do subscribe to our channel and follow Manthan series because here we are completing concepts along with few MCQ practice also. So, let's start today's session. Today, we are going to start Module B, Unit 7 Sources of Finance and Financial Strategies. So, in this particular unit, we are going to talk about finances. Yes, finances means funds. Basically, if you are starting any business, you require what funds? Yes. Now, how you can arrange it? There are different sources, like you can use your own investment, you can borrow from bank. Yes, you can borrow from your friends. But in modern times, if we talk about like Reliance Industries, Tata groups, they are not asking from their friends, not from their families, because they require huge amount of investment. Yes, so what are the ways through which they can arrange their funds? Yes, so let's start this unit. Let's see what are the different ways through which you can arrange funds. So, sources of finances means about your funds. Yes, about your funds. How you can achieve your funds, how you can arrange your funds so that you can run your business. So, basically, if I ask you why you require funds, if you start any business, what is the need of this funds? So, first, let's talk about need for finance. Need for funds. Yes, funds means monetary amount, correct? So all business need funds to run and to start their business. Yes, so basically if you want to start any business, if you want to run your business, you require funds. Now, initial finance is provided by person who originate the business idea, known as owners or promoters. So initially when you start your business, and as a owner, whatever I'm investing, that is what, that is my initial fund. Yes, that is what, that is owner's fund, that is your promoter's fund. Yes, so suppose if here I want to start one furniture business, correct? So initially, how I can arrange the funds? I will use my own saving. Yes, because initially, if I'm starting this business, no bank, no friends, no family member will provide me funds. Yes, because bank also wants this secure business. Yes, so here bank will not provide me any funds. Here my friends will also not provide any funds. My family will also not provide funds because this is my new business. And new businesses always use their owner's amount only. Now, what are the furthermore ways through which you can use these funds? For starting up, for everyday bill payments like salary payment, yes, this bill payment, electricity payment, rent payment, yes, etc. You require funds. Then to take over, suppose recently you must have heard about Reliance acquired Disney Geo Hotstar. Yes, so that is also you require. Then for internal growth, like you want to purchase new machines, yes, new equipments. So for that also you require funds. For expansion, when Reliance started Geo, they're expanding their business, or for replacement, or for replacement of machinery or equipment. Yes, if you are having old machines, you will replace with your funds only. So these are the ways through which you can use your funds. Now, coming to the next uh, part, that is different types of funds. Yes, first we have understood why we require funds. Now, next we are going to talk about what are the types of finances, what are the types of funds, or you can say what are the sources we have, correct? So let's start with the first one, that is equity capital. Then we will talk about internal accruals, preference capital, term loans, debentures, alternative financing strategy. So let's start with the first, that is equity capital. Now equity capital means what? See, let's break this term in two parts, equity and capital. So capital is what? This is the amount invested by the promoter to establish a business. Yes, the owner when they are starting their business, that is what capital. Just now we have taken the example when I want to start my furniture business. So whatever savings I'm using here, that is what? That is capital. Yes, so in accounting terms, it is the amount remaining after selling all assets and paying off all liabilities. Or you can say at the time of liquidation, or no, not talk about, let's not talk about liquidation for time being, let's skip. When you sell all your assets, yes, and if you pay off all your liabilities, yes, whatever amount is left with you, that is your capital. Even this is also known as your balance sheet equation. Yes, that we have seen in your JIB days. This is also known as your balance sheet equation. I hope you can recall this balance sheet equation. That is assets equal to liabilities plus capital. Yes, assets on which you have your ownership or your control, liabilities, that is your obligation. Yes, and capital is the amount that owners invested into business. Correct? So this is what capital means. Now, owner's contribution, capital includes the money brought in by the owner at the business setup and profits retained over time. Now, always remember when we are talking about owner's capital, so this will include two things. Yes, owner's contribution will include two things. First one, whatever amount as a owner, yes, at the time of starting, whatever amount we have invested at the time of your starting of your business, that is what? That is your starting, that is your owner's contribution. Along with this, whatever profits you are generating, yes, after paying your liabilities, your expenses, whatever amount is left with you in terms of profit, that also belongs to owners only. Yes, so this is about your equity capital. Now, we have different terms in this particular equity capital. Now, when we talk about Reliance Industries, yes, Tata Group, so they all are listed companies. Yes, now they have different capital. Now, what each capital talks about, let's see. First capital is your authorized capital, or you can say nominal capital. This is the maximum amount. This is the maximum amount. Yes, this is the maximum capital a company is legally allowed to issue. See, if we talk about Reliance, Tata, or any company, they require to take registration. Yes, they need to take registration, and if you want to call your business as a company, there is a requirement to take registration under Companies Act 2013. Then only you can use this term like private limited or public limited. Yes, if you want to be known as company, you need to compulsory take registration. Like in your banks, you are following Banking Regulation Act. Same for companies, we have a separate act known as Companies Act 2013. As per this act, we are providing separate legal position to the companies, because of which companies can enter into any contract, agreement, in any arrangement. Yes, so this is the meaning of company when they are getting registration as a legal status they are getting. Yes, so when they're getting legal status in the documents, the first term you're going to observe, that is authorized capital, that this company can issue maximum how much amount, or how much amount they can legally they can raise their capital, that is what written in their authorized capital. Yes, now coming to the next one, that is issued share capital. Now, issued share capital means the portion of authorized capital that is offered to public for subscription. So firstly, you are registering your company. Yes, at that time, whatever amount you're mentioning on your documents, that is what authorized capital, nominal capital, that is your maximum capital. Correct? Now, suppose Reliance Industry wants to issue their, you know, Reliance Industry wants to share their ownership to the public. Yes, now when they're sharing their ownership of this Reliance Industry to the public, they will issue the shares to the public. You must have heard about this IPOs, yes, FPOs. So these are the ways through which companies are sharing their ownership. So at that time, whatever amount or whatever the ownership they are offering to the public, that is issued share capital. Yes, that is issued share capital. And your suppose authorized capital is 1 lakh. So the issued capital cannot exceed 1 lakh. Your issued share capital will be equal to or less than, yes, equal to or less than 1 lakh. Yes, always remember this point. The next is your subscribed share capital. Now, companies they are issuing their ownership, yes, but whether as an investor we are ready or not, that depends on us. Correct? If we are purchasing Reliance shares, means we are subscribing to Reliance shares. If we are purchasing Tata shares, means we are subscribing to Tata shares. So that depends on your investor. Yes, that depends on investor. Which company share we are purchasing? Tata's company share we are purchasing, or Reliance company shares we are purchasing, or any third company we are purchasing. So whenever as an investor, yes, we all are investor here. So as an investor, when we are purchasing, that is what subscribed share capital. So portion of issued capital. Now what you will purchase, whatever companies are offering, and companies are offering what? Authorized capital or issued capital? Of course, issued capital. Yes, so they are offering issued capital. And if they are offering issued, so you will purchase issued share only. Correct? So from your side, it will be your subscribed share capital. Then next is your called up share capital. If companies are issuing the shares in an installment manner, yes, like we have EMIs now. If companies issue their shares on that EMI basis, so first allotment they will call, yes, second installment they will call, third installment they will call. If companies are acquiring like this, then that time they will call you. Companies will call you. Suppose you purchased Reliance share, so for the remaining amount, company will call investor. That is called up capital. Part of the subscribed capital that the company has demanded, called from shareholders, maybe in installments as per company needs. Okay. Next is your even, that is paid up capital. Now, as soon as we are paying, when we are receiving call, that is paid up capital. Amount actually received by the company from shareholders against the called up capital. That is what paid up share capital. Then next is your calls in areas. Suppose we are not paying anything. Yes, portion of called up capital not yet paid by some shareholders, might be we are not having that much amount. Yes, to pay our installment. So when we are not paying our installment, that company called, that is your calls in areas. See, they called you, but you didn't pay. So that is calls in areas. Then next is your unpaid share capital. Now, the final amount not received on which management may decide further action. Means, see, company will again call and call. Yes, like in your banks also, if there is any NPA, first bank will try to collect the amount from the customer. So they will try to call. They will send email. They will send some officers also to collect that particular amount. Means we will try different ways to which we can collect it before we call them NPA. Yes, but what if your investor is not paying you at all? Then finally you need to take some action. Yes, finally you will convert them into NPA, that non-performing asset. Same works in companies also. Finally, if investor is not paying again and again, when you are calling using alternative ways, finally your management will decide to take some action on that unpaid call. And finally, on that unpaid call, management can forfeit shares. Forfeit means management can decide now to cancel that shareholders from their register. Yes, so that is what forfeiture. That is what forfeiture. Yes, finally you will cancel. So that is what forfeited shares. Finally, you will strike off the name of that investor from your registered book. So this is about your forfeited shares. So here we complete your equity part. Now, let's talk about next way to arrange funds, that is your internal accruals. Now, internal accruals means within our business. Yes, within our business, whatever we are doing, if we are talking about internally within our business, that is what internal. Yes, so let's talk about the definition here. So companies do not distribute all earnings after tax to shareholders. Means what? See, suppose company earn profit. Suppose this is your Reliance industry. Profit earned rupees 10 lakhs. Yes, now company if earned profit equal to 10 lakh, so they are not going to distribute all 10 lakhs to your investor. Yes, like we are purchasing the equity shares from National Stock Exchange, Bombay Stock Exchange. So in return, we also expect some profit. Yes, because companies are using our amount. They are taking money from us and then they are utilizing it. So we also want some return. But companies, whatever they're earning, they're not going to, distribute everything to their investors. So suppose they are distributing 2 lakhs and remaining 8 lakh they will invest again in their business. Yes, and when they are reinvesting again in the business, this is your internal accruals, or you can say this is your retained profit. This is your retained profit. This is your retained profit. Yes, which you have saved. This is your retained profit. Yes, so when companies are not distributing their each and every profit, and if they are reinvesting their own business, that is what retained profits. So part of the profit after tax is retained in the company, usually reflected in the general reserve. So in your balance sheet, you show your capital. Yes, suppose this is your balance sheet extract. So here you will show your capital. Then after this you will show your reserves. Then you show your liabilities, whether it is short term or long term. Yes, so this is the extract of your liability side, capital, reserves. And where you will see the reserves? Under your this liability side after capital. So retained profits are internal accruals which arise from profit after tax. You can call it as PAT. Yes, then non-cash profits charged to the profit and loss account, in depreciation charged to the profit and loss account. This is how you can generate your internal accruals. Okay, next is your preference shares. This is one of the next ways through which you can arrange funds. Now, preference share capital is similar to your equity. You have just here preference over equity. Yes, this is similar to your equity, but this preference capital is also known as preferred stock, or you can say quasi risk control. Now, in equity, you share ownership. Yes, you share ownership, but in preference shares, no ownership you are sharing. Yes, that's why you will receive fixed dividend. You will receive fixed dividend, and you have life. Yes, but in equity, you are getting no fixed dividend. No fixed dividend. Yes, and no life means till infinity you can hold this equity shares. Along with this, you receive the right to vote in equity. Here, no right to vote. Yes, so this is the difference between equity and preference shares. So preference shares provide fixed dividend rate that paid out of before paying common stock, means your equity. Here, dividends at the time of liquidity, means when you are closing your business. So first you will pay your preference shares, and if any amount is left, then you will pay to your equity. Now, in exchange for this preferential treatment, preference share capital does not typically have voting rights like common stock. Just now what we have discussed, the same thing is provided here. Then we have different types of preference shares. So first let's talk about cumulative preference shares. Now cumulative preference shares means here you will receive fixed dividend, and in any particular year if company is not able to pay you, then you can carry forward it. Like in your salary, you have salary in arrears now. So here also, suppose company issued preference dividend in the first year. After issuing, they paid dividend. Yes, second year again they paid dividend. Third year, suppose, and always remember dividends are paid out from your profits. So company has earned profit in first 2 year. Now in the third year, suppose company earned loss, so there will be no dividend. Yes, no dividend. But in the fourth year, company again earned profit, so here company will pay third year dividend plus fourth year dividend. Yes, means like your salary in arrears, you will receive cumulative preference shares also. Now next is a non-cumulative. Here your right to receive dividend will lapse if company earns loss. Yes, entitled to fixed dividend for sure, but no claim on unpaid dividends. Here you cannot carry forward, no carry forward. Okay, so this is your non-cumulative preference shares. Then participating preference shares. Now fixed dividend plus share in surplus profits after equity shareholders. Now in this participating, you are entitled for fixed dividend for sure, but along with this, at the time of liquidation, means when you are shutting your business down, at that time whatever profits you have earned, in that also you will receive some share. So that is participating preference share. Then non-participating preference shares, only fixed dividend, no right to surplus profit. Yes, only fixed dividend, nothing else. Then redeemable preference shares means you have some specific life. Yes, and India, you cannot issue non-redeemable shares. Remember this point, not permitted under Indian laws. So non-redeemable means no life. Yes, and in India, you cannot issue any preference shares which is not having any life. You need to issue only redeemable, means some specific life preference shares. Now, next is a convertible. Convertible means in this you are receiving right to convert your preference shares into equity. Yes, converted into equity based on preset terms and conditions. You need to comply with terms and conditions. Then non-convertible preference shares, no conversion. Yes, at the time of issue also you are holding preference shares, at the time of redemption also you are holding preference shares. So that is non-convertible preference shares. Then adjustable rate preference shares, no fixed dividend, but dividend varies with market interest rate. Like no fixed dividend rate. Yes, your interest rate will fluctuate based on market. So these are the types of preference shares. Now let's quickly solve few MCQs and let's check our progress. So first question is, equity shareholders are also known as owners of the company, creditors of the company, debenture holders, preference shareholders. See, equity shareholders are known as owners of the company. Yes, correct answer is your A. Then, which statement is true about retained earning? Yes, they are distributed as dividends to shareholder. No. They are shown as an expense. Again, no. They represent the cumulative profits not distributed to the shareholders. Answer is your C. Yes, these are the liabilities of the company. No. Retained earning means you earned profit equal to 1 lakh. Yes, you distributed dividend to your shareholders, suppose 10,000. How much you are going to reinvest to your business? 90,000. So this 90,000 is your retained earning. So correct answer is answer C. Next, preference shareholders are entitled to receive fixed dividend, variable dividends, dividends only after equity shareholders, no dividend. Correct answer is your answer A. Then, cumulative preference shares. Remember cumulative as your salary in arrears. Yes, this is similar to your salary in arrears. So dividends are paid only for the current year. No, dividends not paid in previous year are carry forwarded. Dividends are calculated based on profit growth. Dividends are paid at variable rate. No, correct answer is your answer B. And this is your cumulative preference shares. Okay. So with this, we complete your unit first from your module B, that is sources of finances. Now, if you want to complete your this CAIIB, ABFM, and remaining three compulsory subjects, then you can join our Officers Pro batch, which we are going to start from 25th July. Yes, so 25th July we are starting this batch in which you will receive online live class, mock test, and ebooks. Okay, so this is our Officers Pro batch, and this batch is going to be a conceptual batch. So remember, you can enroll in this batch if you want to clear in your first attempt. Yes, now if you want to join in this batch, you can use this coupon code, that is Y895, through which you will receive maximum discount. Remember, the coupon code is your Y895. Okay, and you can join this Telegram group also by scanning this QR code. You will be the participant of my Telegram group. So now with this, let's wind up the session. So thank you everyone for joining. Take care.